Wall Street's fast food feast continued today. McDonald's, Hershey, Tyson, Chipotle, all fresh all-time highs in today's session. These names adding some tasty gains already baked in for the year. So what's driving the investor appetite for the food stocks? Guy, start.
You know what? I'm not sure what it is. Maybe they're running their businesses better. Maybe people are going down the food chain, no pun intended. But I got to tell you, a couple stocks stick out. Tim's been on this McDonald's for a while. Chipotle, one person's gotten it right, Nicole Regan at Piper Jaffray. But the one we've been talking about here for a while is Shake Shack. Everybody says 110 times forward earnings. It's impossible to maintain this valuation. But you go back and look at the quarter, and their comps are up significantly year over year. They're doing everything right. There's still growth. And as Dan Nathan will tell you, Tyler, any stock that prints 88 is going to, Dan?
100.
Yes, it is.
That's silly.
Wow.
Well, I'll tell you what. So we spent the first part of the show talking about all the hot spots, everything that's negative out here. The one positive thing we have seen here in the U.S. is average hourly earnings are going up. So Americans are making a little bit more money. The U.S. economy is still strong. So you want to stick with ones that are somewhat U.S.-centric, which brings you to like a Chipotle Mexican Grill. Now, it's already had a really good run, but if you're looking for some place to kind of hide out, the relative strength in that is pretty impressive.
The reasons this is happening, Tyler, to me, if you ask me, are a combination of the fact that digitalization, their online, their loyalty programs are leading to, first of all, higher ticket prices. They're getting actually a more loyal fan base or a more loyal customer. You have a dynamic where the guys talked about really who their consumer is, and the consumer is actually doing better. I think these are companies that when McDonald's is growing 6-7% in terms of their
amazing,
that might as well be Amazon.
Okay,
and for this company, relative to itself, when it's actually changing and rehashing its image, when in fact, to me, this is one of the top global iconic brands, that explains why I'm willing to pay more for it, especially in a zero-rate environment.
Doesn't the tech thing kind of age out at some point? Look at Domino's. For a couple years, this thing was a massive outperformer. People were talking about all the improvements that they were making, obviously, on their menu.
It was technology.
We've seen that, and then it was also technology. And now you're seeing that earnings growth is massively decelerating. The stock is not doing what McDonald's or Shack or these others are doing. I think it's down probably 20% from its recent highs, and so some of that is, it's just, this is a stock trading mid 25, 26 times, growing all of a sudden at mid to low teens. And then all of a sudden you say, all right, well, you know, we got that leverage. We kind of moved this thing forward. Right. I don't know. I don't love the tech theme. I think it's transitory, as the Fed might say.
They're giving me a rap.